Good morning, everyone, and welcome to this webinar on Japanese smaller companies. Shortly, we'll be hearing from Joe Bauernfreund, manager of AVI Japan Opportunity Trust. All through the week, we've been looking at the value opportunity in small caps, and Japanese small caps are certainly cheap. AJOT was launched to take advantage of value opportunities in this space and has delivered very strong returns since launch, well ahead of the small cap index, which remains cheap nonetheless. In fact, AJOT trades on a small discount at the time of writing, which has been a relatively rare occurrence, with the shares often trading on a premium. So it's a doubly interesting time to be considering the trust. I will shortly hand over to Joe. We've got 20 minutes or so for presentation. And if you'd like to put any questions to Joe, please do so in the box that should be on the side of your screen, and I'll put them to him at the end. So Joe, over to you.
Great, thank you very much for that introduction, and thank you all for joining me this morning to talk about small caps in the context of the Japanese market. So we launched AVI Japan Opportunity Trust in October 2018 to take advantage of the remarkable valuations that we saw in Japan, particularly amongst small cap companies. And since that time, the fund has grown to about £200 million of assets and has outperformed its benchmark, the MSCI Japan Small Cap Index, by about 34%. We're a team based here in London, primarily. There are 5 dedicated investment professionals focused on the Japan strategy. And we've got one colleague, Jason Bellamy, who's based out in Tokyo permanently. So to set the scene about Japan and about small caps, the last 5 or 6 years have been a period of time in which the small cap index in Japan has underperformed the broader index, the TOPIX, by quite some way. And that's particularly pronounced when you look at the last 12 to 18 months, when the TOPIX has really taken off and when the capital flows from foreign investors really reversed the outflowing trend of previous years and really bought into the story of Japan. It hasn't always been that way. So when you look at the prior 5 years, prior to our launch in October 2018, the situation was reversed. And that was a period of time in which small caps outperformed the larger cap index. So I guess from one perspective, at least, the trend of the last 5 or 6 years is not a structural trend that's existed forever. It's one that has existed for 5 or 6 years. And what it's meant is that the valuations of small cap stocks in Japan, when you look at the price to book ratios and differentials between the large cap index and the small cap index, is extremely pronounced. Small cap index are trading on average just a little bit above book value and closer to 1.5 for the TOPIX index. So the spread or the gap between the two is really at its widest point over the last 10 years. And that's notwithstanding the very strong rally that we saw in Japan generally over the last 12 to 15 months. And although the small cap index has lagged, it also appreciated and also performed reasonably strongly. So that gap is interesting. Now, from AVI's perspective, what we're particularly interested in is not only small cap companies, but we're interested in small cap companies that have got huge amounts of surplus net cash on their balance sheets, that are profitable operating businesses, and that have a reasonable amount of liquidity available to them on the market. So of a market of around 4,000 listed companies in Japan, when we screen for those with more than a third of their market cap in cash or listed securities and have a reasonable daily liquidity in the market, given our assets in the market, we're able to come up with something like 900 companies that tick the initial box. And from there, we aim to build a portfolio that's a lot more concentrated than that. And typically, you'll see within AJOT, we have 15 to 20 core names in the portfolio, with quite some high concentration at the top end of that portfolio. Now, the reason why we focus on this cash-rich universe is really twofold. From a valuation perspective, there's a great degree of undervaluation. When one tracks the performance of a cash-rich universe relative to the rest of the universe in Japan, it has historically outperformed. So backtesting such a universe has outperformed extremely strongly. So that tells us that companies with strong balance sheets do outperform companies with less strong balance sheets. And the other interesting feature of the market opportunity in Japan today is that when one screens the entire market in Japan, it really is the small cap part of it, and particularly those less than £3 billion, and including some at the micro cap end of less than £200 million. It's really those kind of companies that exhibit the greatest degree of undervaluation, the greatest degree of cash or net financial value on the balance sheet. And you see the metrics here on this table. Below £200 million, we're looking at companies with an average EV/EBIT multiple of 6 times, 5 times the slightly larger ones, but with very, very substantial cash backing. And that leaves us with a universe currently of around 824 names to choose from and to research. And why the opportunity exists, some of these reasons behind the opportunity existing will be common for small caps around the world. And some of them will be unique to Japan and will illustrate why we're so excited about the opportunity in Japan, why we were excited 5 years ago, and why we continue to be excited today. So typically for small cap companies, what you've seen over the last decade is a lack of interest. And that's profoundly illustrated when you look at the availability of sell-side research. So Japan suffers from that. It suffers because it's a very large market in the sense that there are far too many listed companies there. And our portfolio, the vast majority of companies do not have very much in the way of sell-side research at all. And that, as I say, is something that's probably unique. And it's also a function of the interest in passives, which has meant that more money has flowed into the largest companies that are listed on markets. But unique to Japan is the fact that Japanese companies have tended to build up huge amounts of net cash on the balance sheet. For years, nothing ever happened to that cash. And so investors got used to thinking that that cash didn't really belong to them, it belonged to the company, which is a subtle difference, but very important in the context of the Japanese market. And over the last 7 or 8 years, what we've seen is a gradual introduction of various regulatory proposals and codes and moves by the regulator and the government to encourage companies and to force companies to do more for shareholders. So that regulatory tailwind in Japan has been introduced to deal with the profound undervaluation. And that has led to a real shift in the environment and in the opportunity. And what I think stands out compared to other global markets is that small caps generally are undervalued, they're unloved, they're neglected, they're overlooked, and that creates an inefficiency and a price dislocation. But in Japan, what you have is a catalyst for addressing that undervaluation. And that catalyst is very much the corporate governance reform that's been introduced, coupled with the encouragement of greater shareholder engagement, shareholder activism, and constructive engagement with companies. So to go back on a couple of those points, this shows you generally on the left-hand side how under-researched the Japanese market is compared to global peers. And it also shows on the right-hand side, if you compare all markets around the world on a GDP basis and then try and analyze how many companies should be listed compared to where the average is, Japan is an outlier in the sense it's got far too many companies, far too many listed companies given its economy size. And part of the factor there is cultural and unique to Japan in that they have a preference for remaining listed. They have an aversion to being taken over, to being private companies. And historically, Japanese people felt there was a degree of prestige in working for a public company rather than a private company. And all of that is changing, and all of that is part of the catalyst for unlocking value within small caps. What we illustrate here is the journey of corporate governance reforms. It started with Abenomics. Under the third arrow of Abenomics, there were structural reforms introduced. There was an attempt to fire up the economy, and most specifically by way of the Corporate Governance Code and the Stewardship Code, which told companies that they have to do more for shareholders, and they have to boost our returns on equity. They have to get cash off the balance sheet and do something productive with it. And then on the flip side, the Stewardship Code told shareholders, you need to start acting like owners of these businesses. You need to vote against management if you're not happy. You need to tell them if you're not happy, rather than passively tick the box in the annual general meeting year in, year out in support of the directors and start acting as owners. And it's taken a long time, but when we look back today over the journey of the last 7, 8, 9 years, we see a completely different environment in Japan. The pace of regulatory attack, if you like, on companies has accelerated over the last couple of years, most notably with the Tokyo Stock Exchange last year, encouraging or requiring companies to address undervaluation. So where companies trade below book, companies now have to tell shareholders what they're going to do about it and how they're going to get their share price above book. And that has meant that when we have conversations with companies, there's much greater degree of urgency from their side to hear what our suggestions are in order to get their share price up. And that's a major cultural shift. 10 years ago, companies in Japan did not care about the share price. They did not want to meet shareholders, and they believed that they were running these companies in the interests of stakeholders other than shareholders. And today, and this was a key ambition of the Corporate Governance Code, today companies recognize that at the very least, they are running these businesses for shareholders alongside other stakeholders, and in some cases, the interests of shareholders come above those of other stakeholders. And what that has led to is an increase in activism. The government and the regulators were very clear from the outset that the mechanism for enforcing the objectives in both the Corporate Governance Code and the Stewardship Code was shareholder activism, shareholder engagement. Now, shareholder activism in Japan is different to shareholder activism elsewhere in the world. It has to be less aggressive, it has to be much more constructive, and it has to avoid shaming and embarrassing management just for the sake of it. But provided one's engagement fits into that box and it's respectful to the way business is conducted in Japan, and it recognizes and respects that, then what we have found is that we've been welcomed almost with open arms in some cases, rather than being resisted and strongly resisted, as would have been the case 10 years ago. So you've seen a massive increase in the number of share buybacks over the last few years, record highs now. The number of shareholder proposals submitted by activist funds to annual general meetings has risen dramatically from a very low starting point 10 years ago, 4 shareholder proposals out of a market of 4,000 companies. Today, 71, a much greater number, still a low proportion. And Japan still stands out, notwithstanding the fact that payout ratios have gone up and share buybacks have increased. Japan still stands out as a market in which the average company has got way too much cash and runs with a very inefficient balance sheet. So to give you some examples of some small cap companies and to give you a flavor for how we position ourselves and the kind of things that are occurring in the market. So NC Holdings is a mini conglomerate, if you like, very small market cap of around £50 million, and a couple of business lines, car park stacking systems, similar. Sorry, hang on, have I lost the screen? Right, back with you. Car park stacking systems primarily. Anyway, AVI became a 23% shareholder. There was another shareholder of similar size, a US fund. We've engaged with management pretty aggressively. We've submitted resolutions to the AGM that resulted in very high payout ratios the last year or so. We've submitted resolutions to appoint directors to the board. But our investment really is in the final legs now, culminating really with a tender offer, a takeover bid by the other large shareholder who made a bit of substantial premium to the prevailing share price and allowing us to exit what was a fairly illiquid investment with a fairly successful IRR, fairly attractive IRR over a period of time of approximately 3 years. So in some respects, having a very large shareholding in very small companies puts us in the driving seat and positions us for a corporate event. And the good thing about Japan right now is that there's a big increase in the number of corporate events. There's a lot of private equity presence in Japan. There's a lot of capital and appetite for these kind of transactions. And slowly but surely, market participants, management of Japanese companies are beginning to understand that they don't need to remain a public company. They can take advantage of privatizations and management buyouts to their benefit, to the benefit of employees, to the benefit of the company, and to the benefit of society at large. One final one, which is a current investment. This is Aiken Chemical. Aiken Chemical is a leader in the manufacture of diagnostics equipment, particularly for colon cancer testing. It has the contract from the NHS here in the UK, whereby everybody of the age of 60, I think it is, in England receives a pack. That's a Aiken Chemical system, but they have a market-leading position in Japan, and they also have a growing presence in other markets in the world, and fantastic opportunity for developing and growing their overseas business. I think they need a bit of help on that front, and that's certainly what we've been engaging with them. But it's a company with far too much cash on the balance sheet. Management have been a little bit sleepy, but it's a company that's got a great product. And they've got a very interesting shareholder register. We own a little bit over 5%. There's another activist with a similar size stake. And dialogues with management indicate that, as is typically the case, you may have one or two holdout older people on the board who are resistant to change, but overwhelmingly, the next level down, the junior level on the board, is very supportive of what we're saying and pushing hard to enact that change. So very undervalued and a very high quality business with a very interesting shareholder register. And in terms of our engagement, it tends to follow a certain pattern. We have a preference for engaging privately and constructively and not seeking to embarrass management. We want to build a partnership relationship and align our interests with them. We will go public when we need to, but that's generally a last resort. And in addition to that, we don't just focus on the cash on the balance sheet. It's only a very small part of what we engage on. After so many years in which particularly small cap companies have been left alone by shareholders, they've accumulated cash on the balance sheet, they really have been undermanaged in many ways. And today they're being tasked with having a higher share price, and oftentimes management don't really know what to do. So a big part of our focus in terms of engagement is helping frame the operational and strategic opportunities and challenges available to the company and helping them navigate those. And that demonstrates our long-term credibility, the fact that we are patient long-term investors and we're not there, as they fear many foreigners are, just to make a quick buck at their expense. And that has proven to be very successful, not only in things like NC, but many other cases as well over the last few years. There's a couple of interesting things just wanted to highlight here. Clearly, AJOT has performed reasonably well over the last 5 or 6 years. Certainly in yen terms, the NAV has more than doubled in those 5 or 6 years. Obviously, there's been a headwind from the currency. But in terms of the available universe, using those very same criteria I described at the outset, there hasn't really been a material change in the number of companies that meet our cash or valuation criteria. So the universe hasn't shrunk. But notwithstanding that, recognizing that we want to run fairly concentrated portfolios and that our engagement is a very intense process, we are very mindful of our capacity. And this is not a strategy that's ever going to have billions of pounds invested in it. More like £1 billion would be the realistic capacity for a small cap Japan strategy such as this. And we aim to grow the assets in the fund, but have respect for the genuine capacity available to us. I'll end just with a portfolio, just to give you a flavour. For the concentration, so the top 10 today makes up just under 70%. It reached a high of around 75% earlier this year. And that I think would probably be a typically high level. You wouldn't expect to see it much higher than that. Generally, what happens is, as ideas come into the portfolio at around 3, 4, 5%, they expand from there based upon the success of our engagement, indications we're getting from that, and conviction building off the back of that. A number of new names have come into the portfolio this last year as we've recycled, and certainly as we get the money back from NC Holdings later in July, we won't have a problem reinvesting that money as we continue to see a huge number of opportunities. And some of these new names are still well below target weights that we would envisage seeing. So really, that's the message I wanted to convey about opportunities for small caps in Japan, and tell you a little bit about our fund. And I'm very happy to take any questions if there are any.
Great, thanks very much, Joe. We have a few questions already, but if you're in the audience, please do put your question through. Perhaps we could start with the sort of the small versus large issue. Is it fair to say that most of the attention this year, as Japan has really picked up as a fashionable pick, has gone so far into the large caps? And are we seeing that start to trickle down to small caps?
Yeah, I would say that certainly the story of 2023 and early 2024 was one in which much of the capital did go into the large caps. When you look at large caps generally in Japan, it's not blindingly obvious that they're cheap. One development that has materialized over the last few months, however, has been that some activist funds have launched campaigns targeting larger companies that previously would have been described as perhaps sacred cows. They would never change. They would never do anything to unlock the value, particularly where they've got cross shareholdings and the like. And there are signs that those kind of companies are feeling the pressure, which I think is positive, because they do still look very cheap. But the encouraging thing from a small cap perspective is that there's a lot more corporate activity going on at the small cap level. There's a lot of corporate activity in terms of transactions involving private equity. There's a lot of takeover bids or tender offers, and a lot of resolutions. And that is primarily focused at the smaller cap end. Now, I don't know whether this is the start of a trend, but if you look back over the last couple of months, there are signs that the small cap index is beginning to outperform the large cap index. And you would expect that as the money gets more confident, capital gets confident, and it has stuck around in Japan for an extended period of time now. It hasn't made the money and then taken the money off the table, which I think is very encouraging. Naturally, you would expect it to trickle down into the small cap where there's much more obvious value.
Yeah, the point of takeover is interesting. So are we now starting to see Japanese large caps who have been mandated to use their cash, using that to take over small caps then? Is this kind of a domestic cycle?
I think there are situations in which larger cap companies who are parents to 51% subsidiaries have taken over their subsidiaries and are likely to continue to do so, and certainly are coming under pressure to do so. There are situations in which large cap companies are being encouraged to dispose of some subsidiaries, and there's a huge amount of capital from the large global private equity houses targeting specifically those opportunities. And then there are a small number of domestic private equity investors or foreign activists who are willing and able to take over companies and take control of companies. And we're seeing pick up in activity there. And the example of NC Holdings is being taken over by a kind of a quasi-activist listed investor, but also comfortable with the idea of owning companies privately. So yeah, it's definitely happening, and there's an appetite for it. The indications were when we launched AJOT 6 years ago that the large private equity houses were there and that they were ready and willing and able and keen to do deals. It has taken a long time for those deals to actually materialize, and the reason is because most companies in Japan were resistant to the idea of being taken over by a foreign private equity. That is changing. They've been wooed by companies have been wooed by wine, dined, golf, what have you, by large cap by private equity, and the more unpleasant or challenging we make their lives, the more they run into the open arms of private equity.
Then, yeah, question about how many competitors you now see compared to, say, 5 years ago. I guess trying to do what you're doing, are you seeing more people trying to do that in your space? And is this helpful, or is this, unwanted competition?
Yeah, well, firstly, we are seeing more vocal investors, and I would say they take different guises. There are some hedge funds cropping up, some more aggressive hedge funds, some less aggressive hedge funds. There are funds similar to what AJOT does cropping up. So yes, the number of activists has grown a little bit. I wouldn't say it's massive, but there are certainly more. The other important aspect is that we're seeing more institutional investors, both domestic, which is very important, and international, who are finding their voice. So, 3, 4, 5 years ago, it was rare to find a Japanese institutional investor who was willing to vote against management, who was willing to support a shareholder resolution that was put forward by a foreign investor. Today, that's not the case. And many companies tell me that they're hearing the same things we're saying, but they're hearing them from the Japanese investors. So that's a very powerful change of course, I would say, for the market. And all of this, I would say, is very helpful. I don't view this as competition for us. The FSA are very clear that not only is the mechanism for enforcing the objectives of the codes going to be shareholder engagement, but collaboration subject to counterparty rules. Collaboration between investors is also a very powerful force, and companies need to be alert to that. Historically, when you used to complain to a company in Japan that you weren't happy, they always love to tell you that you're the only shareholder who was disgruntled. Everybody else loved what they were doing. But now, clearly that's changed, and they recognize that that's not the case, and they recognize that we know that's not the case. So I think it is very helpful to have more people scouring the market. And we do find ourselves on the registers of companies alongside other activists, and we like that. It means that you're more likely to get support, or they're more likely to get support for whatever they might propose.
We had a question about Alp Logistics, which has recently had a very attractive bid. I think, I'm not sure if the deal has gone through or anything, but it was asking you for your thoughts on that. I think that's been quite a successful investment.
Yeah. So Alps Logistics has been in the portfolio from day one. Broadly speaking, I think from memory, we bought the shares well below 1,000 yen, and it's been taken over for well over 3,000 yen. It's a logistics business. It's a very profitable and successful business in a very attractive area of the market. It was trading at a mid to low single-digit EV/EBIT multiple. It was taken over at something like 30 times, which I have to say is well above our expectations. KKR took over a business a couple of years ago at around early 20 multiple. So that was our target, and they've come in and paid something like 30 times for this one, which I guess highlights many of the points I've been making. It highlights how companies with a lot of cash are materially undervalued, and you can buy into them at very low single-digit earning multiples because of the inefficiency of the cash. It highlights the fact that there is pressure on companies to unlock value. In this case, Alps Alpine were the controlling shareholder, and their own situation pressurized them into finding a buyer for their stake, which then led to a bid for the entirety of the company. And it also highlights the appetite of private equity. This was a competitive bid situation, and really was a very successful outcome for all shareholders and for the company as well.
Has the strategy evolved at all since you launched? I think the portfolio has become more concentrated. Is that a deliberate choice?
Yeah, I think it's fair to say that the core philosophy has remained consistent, and that is the idea about buying companies with inefficient balance sheets, too much cash, and good quality businesses. We've probably evolved in two different ways. Number one, in terms of the cash and quality of the business, in the early days, we may have been seduced by businesses that perhaps had a less high quality business, but had more cash. So if we could find a company with 100% cash, we might have been prepared to overlook the quality side to a degree. And that we've moved away from as it's become clearer that it's better to buy better businesses, and to pay a higher multiple and to have less cash on the balance sheet. And the other aspect, which is very important to our strategy and really sets us apart from most of our peers, is the focus on the operational and strategic side of the business, rather than just simply the share price and cash and what you can do to get the share price up as quickly as possible. So really building that engagement relationship with companies by way of demonstrating that we know and care and understand about their business and really want to help them create genuine long-term sustainable value rather than just get a quick one-off on the share price.
We had a question about how you manage the currency risk, and how you think about the volatility of the yen, the possibility for it to wipe out any stock return if the government decides to devalue the yen further.
Well, it's a very complex question, and probably what I've done over the last six or so years disqualifies me from giving a very educated answer. The short answer is we don't hedge the currency, so we take on board the currency risk. And that has been very painful, as we've seen an almost 40% devaluation of the yen against the pound since late 2018. So the situation today is that the yen has been very weak, continues to appear to be very weak, and the divergence between Japan and the rest of the world in terms of the path of interest rates has been the key factor behind that divergence in currencies. So clearly the question is, will that persist? I would say that sitting here today, the likelihood is that the yen strengthens at some point, but clearly that hasn't happened yet and has continued to weaken. But the reason I think that it's likely to strengthen and is very, very undervalued is that we've seen a few important shifts in the economy over the last year. So we've seen inflation come back. We've seen the death of deflation. We've seen wage inflation really hit home in Japan. I think that's the most important statistic. And then on the monetary policy side of things, it's very possible that sometime this year, next year, the Fed start lowering interest rates. It's possible that later this year, perhaps in the next month or so, the Bank of Japan announce another increase in interest rates, along with a reduction in the pace of the bond buying. It's been a big feature of the economy the last few years, and all of those at the margin ought to put a bit of a floor under the yen and allow for a strengthening. But that's we tend not to spend too much time thinking about it, and rather focus on the absolute upside from a valuation perspective of our companies. And what we've demonstrated is that although our returns have been muted by the yen devaluation, notwithstanding that, we've still delivered reasonably healthy absolute returns over the 5 or so years that we've been running this.
And is the kind of improving economic picture, or at least the return of inflation that you mentioned, is that feeding through into the performance of companies? Because I suppose wage inflation is, in abstract, a negative thing for companies, but we're starting from a relatively low base, so perhaps that's not really an issue. Is this an encouraging picture from a business perspective?
Yeah, it's a good question. The big question mark that we had probably 18 months or so ago was you've got raw material prices going up, you've got other input prices going up, energy prices going up, you've got wages going up. Would Japanese companies be able to pass on those higher costs to their clients, or would they take the traditional Japanese path, which is it's disrespectful to loyal customers to ask them to pay more just because our costs have gone up? And would we suffer margin erosion as a consequence of that? And the good news is that perhaps with a lag of 1 quarter or 2 quarters, for the most part, we've seen companies maintain and even grow their margins, notwithstanding those high costs. And I think the fact that there's a greater focus on shareholder returns now and profitability, but also the fact that everybody was in the same boat and facing those same tailwinds, pressures, has meant that they've overcome that sort of fear, psychological, cultural resistance, and have grown their margins. So it's been a positive development.
Great. I have one more question from the floor, but if anyone's sitting there with a question, please do put it in the box. We should have time for that too. Are there any times, given you're quite concentrated in your positions, that you've had trouble exiting a position, or when something goes wrong? How do you manage those situations if you're not getting the response that you need from a company, and you no longer think it's likely to give you that response?
So, of course, you're absolutely right. There are situations where things don't go to plan, and we've made a mistake perhaps, or have to up the ante. So there are a couple of different approaches depending upon the situation. The fact that many more companies are doing share buybacks now has meant that we've had 3 or 4 situations where we've been technically stuck in a position wanting to exit. The market liquidity hasn't been there, and we've been able to persuade management to use their buyback authority and powers to get rid of us off their register and leave them alone. So 3 or 4 companies have used their own capital to get rid of us, and that's been helpful. There are situations where we've just had to take our time and be patient and exit carefully and slowly in the market under normal market liquidity conditions, and that's just a drawn out process. And given the structure of the closed-end fund, it's something we can manage. And then there are situations where we are more stuck, and then we have to, as I say, up the ante, have a public campaign. We've got one portfolio company in there that would fit into that box, and that is sort of just after halfway down on this list that you see here. It's called SK Kaken, which is a specialist paints business, remarkably cheap, more than 100% of their market cap in net cash. A reasonably good business, but controlled by a family, very, very traditional. We've submitted resolutions to the AGMs the last 3 years. The fact that the family is in control has meant that although our resolutions has been going up, the family can do pretty much what they want. This year we'll have representatives of AJOT attending the AGM and voting in person and speaking in person at the AGM, which has further put pressure. There are things that we can do and do, but we have to be mindful that we couldn't manage to do our job well if we had a portfolio dominated by SK Kakens. It's sort of okay to have 1 or 2, but for the most part, we absolutely try and avoid them. And it is very much the larger positions where the engagement experience is that much more positive and gives us that degree of conviction that something will happen.
To what extent are these holdings replicated in AVI Global Trust?
So, as you may know, AVI Global, which we also manage here, has got roughly 20% of its assets invested in Japan. Of that 20%, around 10% is invested in companies that do not feature within AJOT. So they are larger companies. They are still asset rich, discounted valuation companies, but have less of an explicit engagement angle and are more just broad value situations. So that's roughly half. The other half, there will be some overlap. It will tend to be the larger market cap situate companies within AJOT that will be replicated within AVI Global, but the weightings will be very different. So just to illustrate that, the second largest holding within AJOT is TSI Holdings, which is just under 10% of NAV. It is in AVI Global, but it's just under 1% of NAV there. So overlap, but the weightings and concentrations are different given the size of the two funds and the liquidity of the underlying names.
Brilliant. Jim, I think your question on the yen was indeed answered earlier. So if you would check the recording, I think you'll find that Joe gave his views on the yen there. So thanks very much, Joe, for your presentation and for answering all those questions. I hope that was useful to the audience. Yeah, hopefully we'll see you at the next event. So thanks very much, Joe. Have a great afternoon.
Thank you very much for having me. Thank you, everybody.
Bye, everyone.